interest rates to rise to that point on my variable to catch up to that $647, it's going to take more than even this, many more increases than the one that we're looking at coming right now.
Okay, welcome back, everyone. And today we're going to talk about a very exciting and timely topic, and that is fixed versus variable rates. We've got our mortgage expert back on with us, Marco Albanese. Thanks for joining us again here. For the folks and the new folks tuning in, if you could just please introduce yourself and let us know a little bit about your background.
Yeah, thanks for having me back again, Rick. And I hope that people do check some of your other videos out, including the one that we just recently did on reverse mortgages. So again, yeah, my name is Marco Albanese, and I'm with a great group of brokers and agents in a company called CAM Mortgages. We're also part of MCC, so Mortgage Centers of Canada. I've been there for a few years. I've been a property investor for the last 27 years. And yeah, just as you pointed out, the fixed versus variable rate mortgage is something that's a hot topic, and something that a lot of viewers already know because they've chosen one or the other. And yeah, it comes at a perfect time.
Yeah, exactly. What is a fixed rate mortgage versus a variable rate?
So briefly define, a fixed rate mortgage is one where within your term, whatever contract rate you and your lender have decided upon, there cannot be any change regardless of the market, regardless of what happens at the level of the lender.
So you're telling me if my wife and I had a mortgage at 3.79% for a 5-year fixed term, if the bank, for example, raised it to something ridiculous like 7%, within this 5 years for my contract with them, I would still be paying 3.79%. Hence, my payments would not increase at all. Is that correct?
And that's exactly it.
The counterpart to that, which is the variable rate.
So a variable rate mortgage is based on the prime rate. So the prime rate is based on the overnight rate from the Bank of Canada. In essence, it's lesser. It's always lesser than your fixed counterpart. If the prime rate stays stable, your rate stays stable. If the prime rate goes up, that level that it goes up by is added to your interest amount that you pay on your mortgage. If it goes down, as we saw in the last couple of years, and we see a huge amount of people moving over to the variable side, not only because of the lower rates, but because why pay for something more when you don't need to?
Just apples to apples, 5-year variable rate at this time.
On the variable rate right now, you can still get prime. So prime as of today, April 5th, is 2.70.
Okay.
Right? And then it usually comes with a discount.
Okay.
Right? So right now, you're able to get a 2.70 minus 105, right? So the borrower paying a 1.65% rather than that 3.79%.
If you like it so far, hit that like button.
And why would I ever choose a fixed rate at 3.79% when I can get a variable rate, at less than half of that, at 1.6, 1.7%. So if we can jump into, what are the pros and cons on that? Like why would somebody choose one versus the other?
I think culturally, Rick, the banks, our parents, society have always positioned themselves with the 5-year fixed. The bank makes the most money on a 5-year fixed. Myself as a licensed mortgage agent, full disclosure, I make more money if I sell a 5-year fixed.
Okay.
But I don't just put people into products personally that I don't believe in. So I'm gonna say again, for myself, everyone's situation is different. But on a 5-year fix, exactly, why would I pick something if it costs more? So again, on the example, right, for a $600,000 mortgage with a 25-year amortization, at 3.79%, you would have a monthly payment of $3,088.
Okay.
Okay. On the variable side, so again, the prime minus the 1.05 at 1.65%. Today, that same borrower is paying $2,441 per month. That's a big difference of that's a $647 monthly difference.
If I got a 5-year variable rate mortgage, let's say at that 1.7%, and now all of a sudden that same bank for a 5-year variable is now charging 2% because the prime rate has gone up. Okay, do my payments go up, or does more go towards interest and less towards principal?
There are some lenders where you can keep your payments static depending on the agreement that you have with the bank. So they can remain static, Rick. So okay. What would happen in that case is that the portion of that $2,441, the way that it's split between what goes to the principal and what goes to the interest, that will change. The interest portion will go up. The payment to the principal will go down. Right. And so you have your payment remaining static. Okay. So this is really important to understand too, and to be exposed to lenders that have these types of products. There are some products that, yes, those payments will go up. And I'm glad that you brought that up, because it's important for people to know what kind of increase are they looking at, right? What is the effect of a 25 basis points increase? So the math shows that for every $100,000 of mortgage, for every increase of 25 basis points, your mortgage payment will go up $12 per every $100,000 of mortgage.
Okay.
So in our $600,000 mortgage, which is a sizable mortgage for a lot of people, a 25 basis point increase will increase your monthly payment by $72.
Okay.
Right? So it's important to note that. And then again, depending on your lender, you can have the discussion there. There's some lenders where you can have a portion of your mortgage fixed. You can have a portion of your mortgage in a variable rate, both having their own different components. There's so many products that are out there. Favor a variable rate mortgage over a fixed rate mortgage is because of the prepayment penalty.
How much of a penalty would I be looking at in terms of breaking that mortgage?
So as most people that are listening and watching that have a variable rate mortgage, one of the main reasons why you chose it, again, outside of the more favorable rates, is because of the prepayment penalty. So typically for a variable rate mortgage, you're exposed to a penalty that equals up to 3 months of interest. You're able to, without penalty, right? Because the banks like this fact, that you're allowed to switch from a variable to a fixed mortgage without penalty, right? You would start then a brand new 5-year fixed mortgage term, right? But if you're in a 5-year fixed, you are not allowed to go into a variable rate mortgage without paying a penalty. So I think we discussed this on our last podcast, in that stats will show that there's a 60% or more of borrowers break their mortgage term in and around the 3-year mark. Excellent. Right? So I had a client that had a fixed rate mortgage, had a $900,000 mortgage.
Okay.
And when everything was kind of going crazy and the rates were dropping, right? He was only 1 year into his fixed rate mortgage.
Yes. And
asked me, I want to get into a variable rate mortgage. I want to break this mortgage, but because of the size of that mortgage, I told him, usually the rule of thumb, depending on the size of the mortgage and depending on the lender as well, to be honest, because it's different from a big bank to a monoline lender. To break his $900,000 mortgage, right? he had a prepayment penalty to break that mortgage of over $36,000 because it was a fixed rate mortgage.
That's nuts.
And it was a 2.94% interest rate. So it wasn't that it was an exuberant, it wasn't that huge, but when people were signing up, you were able to get 1.15% interest rates when you calculated the prime minus the discounts that lenders were giving. So he wanted to jump in on it.
Wow.
So let's just suppose that his mortgage was variable.
Yes.
And using the same 2.94%.
Okay.
Right? When plugging it into the formula that I use, now everybody, this is another full disclosure. The only truth that you're going to get about your prepayment penalty, right? If what the banks will call an interest rate differential,
yeah,
right, is to contact your branch and your bank and to find out exactly what it is on that date, because it fluctuates also. But again, going back to the example, if on a variable rate mortgage, he would have paid his monthly interest payment was $2,170.50. Multiply that by 3, and you have a prepayment penalty of $6,511.50 compared to $36,000.
And break that mortgage for one reason or another. Your spouse gets that dream job in the States. You have to pick up and leave, or stuff happens, and that's, you got to put a value on that. In that example, 30, that's huge. 36,000 versus 6,000.
Right, and it's one thing, and this is that penalty is completely based on the decision of going fixed rather than variable. Right. One of our industry leaders loves to use the term, or loves to use the phrase, life is variable. Maybe your mortgage should be too. Right. But for the most part, and let's face it, people are going to break their mortgage because something has happened on the negative end. So it's the loss of a job, the breakdown of a marriage, just not being able to live. If you lived in a small condo, you wanted to move out to the suburbs. Again, I've seen it, I've done them, and it's very, very painful to watch people with hard-earned money only to be having to give a major portion of it over to the lender, where the opposite of that. Again, let's keep the fact that the payments are lower, right? In a variable rate mortgage, but the effect that breaking and being exposed to a prepayment penalty that you wouldn't otherwise have with the variable rate mortgage is something that people definitely have to consider, and we're seeing it in the market. More and more people are choosing a variable rate mortgage.
Okay,
so if you're going to a 3.79% 5-year fixed, you now have to qualify a 5.79. That's your stress test now, meaning your purchasing power automatically reduces with that.
Yeah, and it's harder to qualify.
Today's market conditions, and we just heard today, April 5th, 2022, that all of the big banks are expecting a 50 basis points increase at the next meeting to discuss the overnight
50
rate.
basis points means 0.5%, correct?
0.5%.
Okay.
So it's going to make the prime rate go from 2.70 to 3.20 minus whatever discount, depending on the lender that you're going to be using. Everyone feels that within the next couple of years, there's going to be a downward trend to this. There's some people that are in the industry that are saying that these increases are happening to get to a certain point to really test the economy, because their only other way, they cannot go lower than what they were at, right? So as it increases, it's easier obviously to decrease it.
Yeah.
Right. So that 50 basis point overnight rate, if it goes to 1%, well, now the Bank of Canada has something to work with, right? So the point I'm trying to make here is that I would still say to Mr. and Mrs. or whoever it is, stick with the variable. Okay, and let's see what happens within the next couple of years.
Okay.
Let's say that the heat's getting too much under your collar. You don't really feel the comfort. You still feel that the rates are going to continue to increase, and you want to, at this point, you just want to fix it. Again, what I mentioned before, you can speak to your bank, you speak to your broker, you speak to your agent, and these are things that need to be discussed at the very beginning, because again, we would then put you in a position where, yes, you could have a static payment, and just the difference is going to change between your principal and interest payment. But let's say you don't have one of those products. I would then say, worst comes to worst, if I had to pick a fixed rate, I would then pick a 2-year fixed, because I'm allowed to do that. I can move. I can move from my variable to a fixed, but maybe I'll keep it. I'll keep it a little bit of a shorter term, right? Because I can kind of foresee a little more stability in my life over a 24-month period than a 60-month period.
You're right. A lot of people think that 5-year fixed, because it's so common that that's one of the only options out there. But to your point, you can go for a 2-year fixed, a 3-year fixed. Now, just really quick here, a comparable for the same amount of money, a 2-year fixed rate versus a 5-year, would it be lower at the 2-year because you're just locking in for 2 years?
Right. But this is important. This is why it's important for the prepayment penalty. They calculate that interest rate differential, the differential being the key word there, right? Because they're trying to recoup their money. They don't want you to, that's the fixed rate. That's the contract that you did. You pledged to pay a certain interest rate. Now, if you break it, well, they take it back based on what the rate is for that period of time remaining on your mortgage.
Gotcha.
So if you have a bigger gap, so if you're breaking your mortgage after 1 year in a 4-year or 5-year, term, obviously the penalty is much more painful. And again, on a variable rate mortgage, for some lenders, there's some that charge an extra $500 on top of the 3-month interest, depending on how close you do break that mortgage. And again, it's important for me to highlight all the different options that are available for each specific client, because each specific client has its own specific lifestyle and financial, picture that's unique to them.
True.
So you either put calm in them by educating them, right? So for our job is to advise, and our clients' job is to instruct. So whatever their decision is, it's the one that I'm going to bring forward, irrespective of my slant.
Yeah,
that's not. I don't try to sell my opinion. I try to highlight it, because it's not an opinion. It's mathematics, and numbers don't lie. And so when you show your charts and when you show people these are the differences, and again, in this rising rate environment, especially for the fixed rate, if that 3.79 and now you're stress testing at 5.79, and that knocks you out of even you purchasing that property,
right?
Because you don't want to choose a variable rate. It doesn't, to me, it doesn't really make sense. Again, I would tell the client, look, we could take a look. I'm going to be closely watching the rates, seeing where we can be if these rates get to this certain point. Should they increase to that point where, again, you're waking up at 3 a.m. because you just can't sleep at night, we can always get a variable rate mortgage into a fixed rate mortgage.
Yeah.
My positioning on that would be pick a shorter term.
Or like you said before, there's even options where you can put a portion of that, so you kind of get a little bit of
That's right.
best of both worlds. Of the 500,000 mortgage, maybe you put 250,000 in the fixed, 250,000 keep it in the variable. So there's definitely different options. But anyway, that's why they would call an expert such as yourself to talk about their mortgage, Marco, because you're the expert. You're looking at it every day. You're not doing this part-time. This is your full-time gig, and you know the stuff inside out. You're watching it daily, so they don't have to. So that's excellent. Well, again, this is
and people have to understand that the market always goes through these ebbs and flows.
Right.
And if I would put one more point, if I can add one more point, that
yes,
over the last 25 years, right, and these stats come from one of my lenders, over the last 25 years, people that have chosen 5-year terms, be it fixed or variable, those people that have chosen the 5-year variable 5 times, 25 years, 5 times 5, have fared better than the fixed rate counterpart. So again, it's 25 years is quite a bit of time to show the difference between, and we're talking about 1% to 1.5%, depending on the lender and and depending on the product.
So
but
financially, they would have been way better off choosing variable over fixed, even
and irrespective of the increases in the prime rate and decreases, right? Gotcha. So again, I still think, to quote one of our industry leaders, life is variable. Maybe your mortgage should be too.
Yeah, well, that's excellent. Well, again, I really appreciate it. This has been fantastic. Look forward to future podcasts with you. Once again, I will be showing your information on how people can get in touch with you, whether it be email or calling your cell directly. I will have it displayed in this video as well as in the video description. Once again, it's been an extreme pleasure, and thank you so much.
Yeah, thank you, Rick, and thank you to all your viewers and listeners, and I look forward to our next podcast. Thanks a lot, Rick.
Hope that helped. Love to share this free information. Your only cost is a free subscribe and a free like. So if you would do me that kind favor, I'd greatly appreciate it, so I could bring more of this content to more people, helping you to build your wealth. Bye for now.